Welcome today to Student Loan Management. This is a webinar for April in our Get Savvy, Grow Your Green Stuff webinar series. My name is Andrea Pellegrini, and I run the Student Money Management Center for the entire University of Illinois system out of University Bursar. And I'm joined today by my colleagues, Nikki and Zach. Nikki, do you want to introduce yourself to our attendees today?
Sure. My name is Nikki Jankola Shanks, and I am the policy director for the Lieutenant Governor, Juliana Stratton. Thanks for having
Thank,
me.
thank you, Nikki. Zach, would you like to introduce yourself?
Absolutely. My name is Zachary Smith, and I'm a regional director at Access Lex Institute, which is a national nonprofit in the legal education space. Prior to joining Access Lex, I was a financial aid advisor and heavily involved in the financial aid space, especially for graduate and professional students. So I've been tracking a lot of the changes with the Big Beautiful Bill, as well as a lot of the negotiated rulemaking and all of that stuff, and hoping to share that expertise with y'all today.
We are very glad that Zach joined us to co-host this webinar because it is hard to keep up on all things student loans right now. Collectively, the Get Savvy team represents organizations across the state of Illinois, which rest on the ancestral lands of multiple Native nations, including the Peoria, Kaskaskia, Piankashaw, Wea, Miami, Mascoutin, Ottawa, Sauk, Meskwaki, Kickapoo, Potawatomi, Ojibwe, and Chickasha nations. And we have a responsibility to acknowledge these Native nations and work with them towards a more vibrant and inclusive society. And if you don't know, we like to know a little bit about our participants. So I just launched a demographics poll. Hopefully it popped up for you. It asks a little bit of information about what age range you're in, whether you're a student, a full-time employee, if you're associated with the University of Illinois system, which campus or university you're associated with, or if you heard about this webinar series through one of our other partners, like the Illinois Department of Financial and Professional Regulation, the Department of Insurance, the Office of Illinois Lieutenant Governor Juliana Stratton, or the U.S. Securities and Exchange Commission. And since Access Lex was a late add to the collaborators on Get Savvy, you can put other if you heard about it from Access Lex. And so that gives us a little information about how to approach examples and how to talk about things that are more relevant to those of you in attendance. But again, we are recording this. And so this recording will be on the University of Illinois System Student Money Management Center's YouTube channel once it is all captioned appropriately. All right, so it looks like we have a pretty diverse group. I'll share the results real quick. So everyone between ages 18 and 54 are on. We have lots of students, but an equal amount of full-time employees. We also have a lot of folks from Urbana and Chicago, and we have a lot of female on today, and this is very helpful for us. Thank you so much. I will stop sharing. If you still see that demographics poll, you can click out of it, and we should still be able to pop up the next poll when it comes available. So we're going to address lots of different concepts throughout today's webinar. You may have more specific questions, or you may not be sure which questions to ask, and that's why you're here, and that's great. So if you do think of any questions throughout the webinar, please don't hesitate to use the chat feature to ask. We also have the Q&A feature turned on if you want to ask anonymously, and we can try to address those after we run through as much of the learning objectives as possible. So we're going to talk about some common myths and facts surrounding student loans. We're going to talk to you about how to identify the types of loans that you have and what tools to use to find out information about them. You also want to know how much you owe and who you have to pay. So that's where those tools are valuable. We're also going to understand, hopefully you'll be able to understand a few different methods for managing student loans, and you'll be more able to create a plan for managing student loans. We also need to acknowledge that we're not going to cover absolutely every aspect of loans on today's webinar. If you have a question about your specific student loans, please contact your school, your servicers or federal student aid at the U.S. Department of Education if you have federal loans. Any information about federal student loans changes extremely frequently. So what is discussed in this webinar is current as of April 1, 2026 at noon Central Time, as far as we know. We might have missed a new publication while we were starting this webinar, but as far as we know, this is up to date. So there have been some new rules on loans introduced, and here are just a couple highlights that we want to put out there for you. So for example, Grad Plus loans are sunsetting. So if you're starting a new program after July 1 of this year, you won't be able to use Grad Plus loans. Those are loans that are credit-based. So if you're continuing in a program, you'll still have access until the completion of your program, but there will be no new Grad Plus loans for new students. Annual and aggregate borrowing limits are also changing, which we'll talk about more later. Repayment options for borrowers that receive federal loans after July 1 of this year, 2026, are also changing, which we'll be talking about in more depth. And then those enrolled in income contingent repayment, pay as you earn, or the saving on a valuable education plans will also have to switch to a new plan. And for SAVE, the Department of Ed just recently announced that you will have 90 days from July 1 to switch to another plan. So that July 1 of 2028 date just refers to those in income contingent repayment and pay as you earn plans. So there are basically three main categories of student loans when it comes to loans. There's federal, institutional, or private. So direct loans are the only type of federal loans available today, but they come in a few different flavors and their availability is also changing. So direct subsidized is for undergraduate students with financial need, where the government pays interest on your behalf while you're in school. Direct unsubsidized is for either undergraduates or graduate students, and interest accrues immediately after it's dispersed. Direct Plus has been historically for either graduate students or parents of undergraduate students and is based on creditworthiness, but it is sunsetting for grad students, and there are now limits for parents. And then there's also a direct consolidation loan, which is a federal loan, which allows you to combine different types of federal loans. Like maybe you had a federal family education loan, commonly called FFEL or FEL, and then went back to school and you got a direct unsubsidized loan. And now you want to combine them to either qualify for different repayment options or simplify managing your loans. The consolidation loan is for that. Institutional loans are dispersed through your school. There have been a few unique campus-based federal loans that fall into the institutional loan bucket, but are actually federally seeded loans. So you have access to federal repayment options if you have one of those loans. And these include the now retired Perkins loan and the health professions loan as well. And then there are private loans, and the repayment and qualifications for those loans vary extensively by lender. We've been producing a lot more educational content on understanding private loans, which is available on the Student Money Management Center website. And I'm sure a lot of other educational institutions are doing the same thing. So with that in mind, we have another poll to kind of know where you are in this kind of student loan status journey. Do you have federal loans? Do you have private? You have institutional? Do you have a mix, or maybe you're unsure? We'll give you a couple minutes to respond to that. We also have another question for you to answer in that same poll. Where are you in your academic journey? So are you a new student starting after July 1, 2026? Are you a current student who's continuing in the fall? Are you graduated already or graduating before July 1 of this year? Or are you graduating this year and entering a new program in the fall? So Zach, why might it be important for people to think about where they are in their academic journey and what kinds of loans that they have.
Absolutely. So those key dates are going to basically split borrowers into pretty distinct cohorts. And so can we actually move over to the next slide?
Yes, it looks like just from the poll, we have people across a couple different buckets. So I wasn't sure if you saw that.
Yep.
But most people have
Primarily,
federal.
okay. So mostly federal borrowers, mostly either current continuing students or students who are anticipating they're going to graduate before. So that is going to be primarily these second two cohorts. We'll run through the first cohort real quick. So anybody just didn't self-identify as a new student starting a program after July 1 of 2026, you would, if that is a graduate or professional level program, you would not be able to borrow Grad Plus. You would be able to borrow the federal direct unsubsidized loan at the new annual and new aggregate limits, which would be at the annual level, at the graduate level, that is $20,500 per academic year, or $100,000 over your lifetime for graduate study. And then for professional school, that annual limit goes up to $50,000 a year, and a lifetime limit of $200,000 there. And because you would be taking out new loans after July 1st, you would only have the new federal student loan repayment options, which will be the new tiered standard repayment plan or that income-driven repayment assistance plan. Now, for the two cohorts that are primarily represented on the call, current continuing students, you can continue to borrow direct unsubsidized loans and graduate plus loans if you're in a program that qualifies under the current limits for up to the remainder of your expected time to credentials. So the expected time to graduation for you, or 3 academic years, whichever is less. And then if you are going to be borrowing any new federal student loans after July 1st of this year, regardless of if it is an unsubsidized loan or Grad Plus loan or anything like that, once you take out one of those new loans, you fall under the definition of a new borrower for the repayment process, and you would only have access to the new tiered standard repayment plan and that income-driven repayment assistance plan. And then for those who are graduating prior to July 1, 2026, because you'll be, in theory, will be taking out no new federal student loans after July 1 of 2026. The only exception to that would be if you were to consolidate your loans after July 1st. That would count as taking out a new loan, and then you would fall under the new borrower repayment options. But if you don't take out any new loans, you will have access to the existing fixed payment or balance-driven repayment plans. That is that 10-year standard, 25-year extended, and then the graduated repayment plans. And then you will have some expanded income-driven repayment plan eligibility. You'll have access to income-based repayment in the long run and the repayment assistance plan in the long run. And then in the short term, between now and July of 2028, you can utilize that pay-as-you-earn plan or income contingent. And then one more note for any borrowers who happen to be in SAVE, you will need to switch out of SAVE 90 days from July 1st of this year, or within 90 days of July 1st this year. And then if we can click over to that next slide, if as staff, you are regularly meeting with students who are getting ready to graduate and are confused about the various different cohorts they may fall into with their various different loans, we have created a flowchart that is pretty helpful as you're counseling students to work through. This flowchart is available for download on our website, accesslex.org, also available through that QR code that is on the slide as well. Alrighty, and I believe we'll be handing things over to Nikki for the myth and fact section.
Thanks, guys. So, as everybody is probably aware, it is very difficult in today's day and age to know what's true and what's not. And there's a lot of social media rumors about student loans. We're going to go through a few of these, and you guys can use the chat function to say if it's true or false, myth or fact. So the first one, if you don't graduate, you don't have to repay your federal student loans. Is that myth or fact? Again, you guys can use that chat button, the chat feature.
We may have a shy group this time, so
Okay.
in
All right.
the interest of time, let's move fast through them.
Yes. All right. So this is in fact a myth. No matter what type of loan you have, federal, private, institutional loans, they all have to be repaid regardless of your degree status. So whether you don't graduate or you need to repay what you take out. All right, next. You must consolidate your loans as soon as you graduate. You guys can think it through. And then it is a myth that you must consolidate your loans when you graduate. It's not necessary if you already have all direct student loans. And there are certain situations that it may be helpful, but that's individual and you want to look at all of your choices. You have a 6-month grace period after leaving school or dropping below half-time before you need to begin repaying your student loans. That is typically true. The typical grace periods are 6 months for federal loans, 9 months for federal Perkins loans, if anybody still has those. That would have been a while ago if you had taken those out. But two things I want to note here. You are still accruing interest during your grace period if you have unsubsidized student loans, or if you have subsidized student loans between like July 1st, 2012 and July 1st, 2014. But just know you are likely still accruing interest. The other thing is that if you have a private loan, you may not have a grace period. So a lot of people have a mix of the federal and private. So your federal, you may have a grace period, but your private loan, you may not. So make sure you're looking that up so you know. All right, it's easy to get your student loans discharged in bankruptcy. True or false? Yes, I see it. Myth, definitely. Bankruptcy discharge is technically possible, but it is very hard and it should definitely not be relied upon. Refinancing federal loans causes you to lose access to federal repayment and forgiveness options. Do we think that's a myth or a fact? That is actually true. So refinancing, if somebody offers you to refinance your loan, refinancing is only for private loans. Private loans cannot be used for any federal loan benefits, such as repayment options. There's a chance that you may pay less in interest by refinancing your loans depending on your situation. But just know that if you do that, that you are going to be ineligible for federal loan benefits.
Nikki, can I just add one thing?
Yes.
It just to emphasize, you can refinance your federal loans, but it turns it into a private loan. And that's what we want to emphasize there.
Yes. And I think the next slide kind of talks about that more. So if you have a federal loan and you choose to refinance it into a private loan, that means you are not going to be able to access repayment options that are available for federal loans and any federal forgiveness programs. All right. If the Trump administration shuts down the Department of Education, I won't have to pay my student loans. Myth or a fact? That is, in fact, a myth. I think that this was really prevalent about a year ago when there were rumors about the Department of Ed shutting down. Student loan debt is likely going to get moved to another executive department. It looks like perhaps the Treasury. So you will still have to repay your loans. It just may be to a different federal agency, but you will still have to repay it. And now I think I'm going to turn it back over to Andrea.
Thank you so much, Nikki. So let's talk about ways to keep your student loans organized based on your situation. So just to do a basic overview of the loan management process, most of you already know how this works based on where you are in the student loan journey, but you typically you apply through FAFSA or you apply for private loans. The disbursement happens through your school and you must accept the loans before a disbursement occurs. You also need to include or complete entrance loan counseling and a master promissory note, which is good for 10 years. So you may not even remember ever signing that master promissory note if you've been in school for a while, but you did sign one. They are good for 10 years. Once you're in school, you get new loans, possibly every semester. And then when you're leaving school, either dropping below half time or you withdraw or you graduate, you enter repayment later. Typically that 6-month grace period for federal loans. Some private loans have a grace period, but again, you are accruing interest on any unsubsidized loans that you have. While you're in repayment, you might be using specific tax credits or deductions. You might also need to consider different repayment plans, and you have to track your paperwork and your repayment history. And then eventually it's paid off or forgiven or canceled. So that's the very basic loan management process. A lot easier on paper than it is in real life. So in order to kind of understand where you are, you want to gather information to know how much you owe, what types of loans that you have, and who your loan servicers are. So what if you don't know who your loan servicer is or how much you have in loans? You can go to the FSA website and log in with your FSA ID and password. It likely is the same as what you did to fill out your FAFSA if you have federal loans. There are a whole bunch of different student loan servicers employed by the Department of Education, so that information will be listed there. You can also contact your school's financial aid or student loan office if they have one to find out about your loans, whether they are federal or institutional. For private loans that you're not sure who to contact, you can pull your credit reports on annualcreditreport.com for free. You can do this weekly, but you are legally entitled to your credit reports once every 12 months. Remember, credit reports and credit scores are different. That's all I'm going to say about credit for now, so we can stay focused on student loans. So one thing that we mentioned is that aggregate loan limits are changing. There's no change for undergraduate students, but there are changes for graduate and professional students. So Grad Plus previously had no limit and is not going to be available after July 1. So that is something to consider. We mentioned that earlier. Again, there are legacy provisions for people that are finishing their programs. Parent Plus had no limit previously, but will after July 1 of 2026. And there are different aggregate limits based on what type of program you're in. So there's grad limits of 100,000 aggregate, that's total just for graduate school. Previously, it was 138.5 for all loans, including undergraduate loans. So that's kind of an increase. And then for professional students, it varied between 138.5 and 224. And how the department is defining professional school versus grad school is a little bit different. So just keep that in mind. We're going to keep it high level for this particular webinar and recording, but those are things to keep in mind. You can look on the FSA website for details that might be specific to your individual situation. All right, so if you are seeking a loan, again, you have to complete the FAFSA, look at your credit history, potentially. Talk to potential co-signers if you are looking for a private loan. And if you do want a private loan, you want to apply and compare in a short time frame. You want to compare different interest rates and different terms so you know what to expect for each one. They are all different. So those are the guidelines for what to look for. Here are a couple more things to ask when you're comparing private loans. What are the requirements to qualify? If you need a cosigner, will you need one? What are the interest rates? Fixed remains constant throughout the term of the loan, the entire time frame that you are repaying. Variable will fluctuate. It's usually connected to some type of index that's tracked in it, and so that might change. So it's important to know based on planning, right? Whether you have a fixed or a variable interest rate. You also want to know what the administrative cost is. So these are typically called origination fees, and federal loans do also have origination fees. They're just loaded into the front of the loan. But that is something you want to ask about with private loans since it can vary. And you also want to know, when does repayment restart? And if you have a grace period, if there are any options similar to forbearance or deferment, and if there are any late payment penalties or early payoff penalties. For example, maybe you get a really good job and you want to pay off that loan a little bit earlier than your term is. You want to know if there are penalties for that. So this is an example of a private loan comparison. Because we have so much to go through, I'm not going to spend a lot of time here, but I want you to notice that none of the details are the same across the board. The interest rates are all different. The origination fees differ significantly, and 1% or 2% of a loan amount doesn't sound like a lot unless you are borrowing significant amount, which could happen for people that are in graduate and professional programs that are more expensive but have higher income potential. So that's something to consider. The repayment terms are also different between the three of them. And so these are all things that you want to keep in mind when you're comparing different private loans. As you might guess, credit is extremely important when it comes to private loans. And we have tons of resources to learn more about credit on our website. We've done several episodes of our Making Sense of Money podcast with the Illinois Department of Financial and Professional Regulation, specifically on credit and how it applies to students. We also have several different web pages and webinars focused explicitly on how to understand credit, because it can kind of seem like a big black box sometimes. So to try to simplify some of this, while you're in school, you want to keep track of what you have and manage loans, know what you're offered, what you accepted, what was dispersed as well. You want to cancel any loans that you don't need in order to reduce the origination fee costs of your loans, which you can do through your school. You also want to keep track of who your servicer is and the balance. And you want to maybe consider early payments since interest accrues on unsubsidized loans while you are in school. But there are different things to consider depending on the amount that you are taking out and whether or not you are employed or generating any income at all while you're in school. It might be a better idea to reduce your loans completely than to pay interest as it accrues while you're in school. If you are leaving school or going part-time, you want to make sure to keep all of your information up to date with your servicers and the FSA dashboard. You also want to keep track of your loan details still. You want to know who the servicer is, the balance, any of the repayment terms. This includes federal and private loans and institutional loans. You also will want to complete exit counseling, which is required for federal loan borrowers, and check your grace period so that you know when repayment will begin. Once you're in repayment, which I think a lot of you are, you want to make sure that you are keeping payment records, even with automatic direct deposit or ACH payments set up, just so you know you're making payments and you're keeping records of that in case someone says, no, you haven't paid off your loan yet. You can provide records of that. You also want to understand what forgiveness programs exist if you are going to be taking advantage of those. And if you're struggling to make payments, it's important to know what deferment or forbearance options that you have, especially with federal loans, but you also have to keep track more closely with private loans if that is something that's an option in your contract. And you also want to know your rights so you can protect yourself from being mistreated or from being a victim of fraud. Two things I want to just mention about taxes. You might have to use these forms when filing your taxes when it comes to funding your education. Form 1098-T is used to determine if you're eligible for the American Opportunity Tax Credit or the Lifetime Learning Credit. Form 1098-E is used to deduct up to $2,500 worth of interest payments you've made towards your student loans from what you owe in taxes. So they are different forms that are used for different purposes, but sometimes people get confused on them. And I'm going to hand it back over to Zach to talk about repayment.
Perfect. And we should be good to move on to that next slide. So, big part of understanding repayment is being aware of what kinds of federal student loans that we currently have and how those are treated during the repayment process. So we've got those federal direct subsidized loans. We can only receive these as undergraduate students. And the big thing here is the federal government is paying the interest while you are in school and during that 6-month grace period, with the exception of, again, a couple of years back in between 2012 and 2014. But for the vast majority of federal direct subsidized loan borrowers, you will not be accruing interest while you're in school or during your grace period or during any other future periods of deferment. Okay. We've got those direct unsubsidized loans. These are available at all academic levels, so undergrad, grad, and professionals. These are not need-based loans. So if you qualify for the federal student loan programs, you qualify for the unsubsidized loan, and there is no financial need component, whereas that is a requirement with those subsidized loans. Then we've got the PLUS loan programs, which encompass both graduate PLUS loans and parent PLUS loans. For graduate students, those loans, again, being sunset for students starting new graduate or professional degrees after July 1st of this year. For parent PLUS borrowers, if your student is currently in school, then you are being processed with similar legacy provisions where there are no loan limits for, again, up to the remaining time to credential for your student or 3 academic years, whichever is shorter. And then if you have students that are starting a new program after July 1st of 2026, then you will have a new annual parent PLUS borrowing limits and aggregate PLUS borrowing limits. And those are set by student. So it is child specific for you. Then we've got those direct consolidation loans. Here, consolidation is really a lot less required and a lot less helpful than it used to be. Direct consolidation now, the 2 primary reasons we see students consolidate is if they've got some of those older federal student loans like FFEL loans or Perkins loans, and they're trying to get those to count for public service loan forgiveness. That is still a valid use of consolidation. And if we're in one of those situations where we have federal student loans that are held by multiple federal student loan servicers, and so we're having to make payments in multiple places, consolidation is a way to get all of our payments in one place again. But big things to note with the consolidation process is the new interest rate you're offered is based on a weighted average of the underlying loans, and then they actually end up rounding up to the nearest eighth of a percent. So we usually don't get a better interest rate when we consolidate. If anything, we typically see our rates go up a little bit. So important things to keep in mind with those federal student loans. Then we are ready for that next slide. So if we ended up borrowing more than we needed and we catch this during the academic year, we have 120 days from each disbursement date to cancel federal student loan funding through the school and have those funds returned, and we actually get a small refund of that origination fee, which ends up paying off a little bit more of our student loans. If you find yourself in this situation where you have a little bit extra, you can work with your financial aid office to cancel any unneeded federal student loans and also avoid some origination fees during that process as well. And then when it comes to figuring out our best repayment strategy, you have support through this process. Work with your financial aid office as you're getting ready to graduate. They can help you work through some of this stuff. You also have access to coaching outside of your school as well. But here are some of the things you'll need to think through. So a lot of our repayment strategy is really going to be determined by what our life looks like post school. So what kind of job do we have, and what is our level of income? That is going to determine things like how aggressive can we get in repayment? How much money am I going to have every month to put towards student loans? Do I need to look at lowering my payments from, the default plan that I'm going to go into because my level of income was lower than I was anticipating? Things like that. We also know that loan repayment plays into our taxes primarily through the fact that interest paid on student loans is tax deductible up to $2,500. But also our marital tax filing status will also affect some of our loan repayments depending on the plans that we're in. So if we're utilizing an income-driven repayment plan, our marital and tax filing status does affect how those payments are calculated and things like that. Our family size and number of dependents in our household is going to play into some of how our payments are calculated, especially again under those income-driven repayment plans. But then things like the level of savings that we have and our other insurance needs and where in the country we live, all of those things are going to play into how much money we have available for the repayment process. During this process, we also probably fairly early on want to identify all of our loan information. So Andrea already walked through this a little bit already. Knowing where to go to find your loan information for these various different loans, making sure you're aware, and then where applicable, using those loan repayment calculators, whether it's the Federal Student Loan Simulator or another loan calculator to start seeing what your potential payments could be post-law school. Post, I am very used to talking to law students. Post undergrad, grad, or professional school, you can look at what those repayment options are going to be. And then our specific repayment goals, those can change over time, but in general, we can pay off debt as quick as possible, find our lowest monthly payment, or just pay the least amount on our loans over time. There are a bunch of different potential repayment goals that we can have. Those may change and shift over time as these elements under personal info change and shift over time. So it's not necessarily something that's going to be static. It is something that we may end up revisiting throughout the process. And then we can move to that next slide. So what are the current repayment plans? Okay, so for those who are either graduating before July 1st of this year or those who plan to just not take out any new federal student loans after July 1st of this year, you will have access to the current plans. So that is that standard 10-year repayment plan, the two different graduated repayment plans. There's a 10-year and a 25-year of that, the extended 25-year plan, and then the income-driven repayment plans that currently exist are income-based repayment, income contingent repayment, pay as you earn, and the saving on a valuable education or SAVE plan. Now, SAVE, we already addressed, that is not coming back. Pay as you earn and income contingent, those are going to be short term through July of 2028. And then IBR is a longer term plan that you'll have access to as long as you are in repayment and you do not take out any new loans after July 1st of this year. As soon as we take out a new loan after July 1st, we are handled under the new plans, regardless of what our borrowing looked like up to that point. As soon as we have a new loan, then we are handled under the new plans. We've got the new tiered standard repayment plan. And how this is changing is the timeline that we will qualify for is going to be based on our total student loan debt. So it is broken down by the totals there. The big thing here is historically we weren't shuttled between these different tiers. So now we could be put into a longer tier, even if we can afford to make higher payments and pay off our loans sooner. So we need to be aware if we are just making our minimum payments and we're being put into one of these extended timelines, we're going to pay more in interest over the lifetime of repayment of that loan. And then our primary income-driven repayment option becomes the repayment assistance plan, which also has the way that payments are calculated are based off of our AGI, and the percentage of our AGI that they're looking at is on a sliding scale of what our AGI ends up being. And then if you are wanting to compare these repayment plans at a glance, we do have a PDF on our website that does this as well. On the front, just compares the plans for you, and then on the back, it gives you that tiered standard repayment plan schedule and the AGI schedule and payment calculation for the repayment assistance plan. So both very, very helpful on this resource. And then once we have collected all of our loan information, that is when we then go to some sort of loan calculator or loan simulator. The federal student loan simulator, to our knowledge, has not been updated with these new repayment plans yet. So you're still going to see the old repayment plans when you work through this calculator, but it should be updated hopefully by the end of this spring semester. That being said, it is the Department of Education and they are on their own timeline, so it could be later than that. But the repayment assistance plan opens July 1st. So in theory, they kind of need this working before that plan goes into effect. A few different ways you can use the simulator. You can skip through, start from scratch and just enter your loans or have them import your loans and then go through that. You can also, they have a skip logic built into these where you can kind of answer a few different questions and they'll give you a recommendation on what plans may work best for you. Okay. Now, this is what I was mentioning earlier with the fact that these new longer repayment terms can actually end up costing us more over time. So on this left-hand side is a borrower who took out $35,000 and they were put into that original 10-year standard repayment plan. If they were to make their monthly minimum payments of $397.42 over that 10-year period, they're going to pay just under $12,700 in interest over the lifetime of that loan for a total repayment of just under $47,700. Now, if the student graduated and took out new loans after July 1st, they would not be put into a 10-year plan. They would actually be put into that 15-year timeline. And if they were to just make those minimum monthly payments, that payment amount is lower. It's only 304 a month, but we're going to pay more, about $7,200 more in interest over the lifetime of these loans. And the total amount that we're going to pay on our loans is going to go up as well. So even if you qualify for a longer repayment term, it may still make sense for you to make extra payments on top of that to try to accelerate your repayment timeline a little bit sooner. And that's going to help you avoid some excess interest in the long run. That being said, you really would only want to do that if you have the financial flexibility and capability to make those extra payments. But if you do, it is going to set you up for success. Okay. And then let's talk about the differences between consolidation and refinancing, because they are related, but there are some very, very key differences that we want to keep in mind. Okay. On the consolidation side, this is something that only happens within the federal ecosystem, and only federal student loans can be included in this process. So for example, if we have a private student loan, we cannot consolidate it with our federal student loans to get that private student loan to count for the federal repayment plans. It just doesn't work that way. Only federal student loans included. They typically, again, this does not result in a lower interest rate. It is based off of the weighted average of the underlying loans, but there is a maximum interest rate that it has to fall under. There is not a credit check required to consolidate your federal student loans. You will typically not end up saving money in the long term, but it may allow you to lower your monthly payment because consolidating student loans extends our repayment timeline. So we'll lower our monthly payment, but if we remember from that previous slide where we have that lower monthly payment but a longer timeline, we're going to pay more in interest over the lifetime of the loan. Direct consolidation loans are eligible for all of the income-driven repayment plans. They're eligible for public service loan forgiveness, which is why consolidating ineligible loans helps us qualify for things like public service loan forgiveness. And then, of course, it would not fall under the federal Perkins loan forgiveness, because if you were consolidating that Perkins loan, it is now no longer a Perkins loan. It is now a direct consolidation loan. Now, refinancing is similar, but it only happens in the private student loan market. But here we can consolidate both private and federal student loans. So we may have multiple private student loans that we're trying to refinance and get a better interest rate on, or we may have a mix of federal and private student loans. Or you may have only borrowed federal student loans, but you were in school when interest rates were historically high. If there are any grad or professional students on the line, spoiler alert, you have been in grad or professional school during a time that interest rates have been historically high for those types of loans. And so refinancing may be a valid option for you. Because it is a private student loan, most refinancing lenders will offer fixed or variable interest rate loans, or variable interest rates. And the interest rate that you are offered is directly based off of your credit score, your credit worthiness, and or the credit score and credit worthiness of a cosigner. It will be a full credit check. So this will be a hard inquiry that shows up on your credit report. And the reason that most people refinance is to try to save money. It is to try to get a lower interest rate or potentially more favorable repayment terms. But usually the motive behind refinancing is to try to save ourselves some money, especially on interest in the long run. It can absolutely lower our monthly payment. However, because they're private student loans, they are not going to qualify for any of those federal repayment programs or any of the federal forgiveness programs. So that is something we need to keep in mind as well. If there's kind of any chance we're going to go into public service work and want to utilize public service loan forgiveness, we want to keep our federal loans in the ecosystem, in the federal system, until we know for sure that we're not going to be pursuing a career in public service and utilizing public service loan forgiveness.
Zach, can I add
Yeah.
one comment real quickly because we have some Q&A questions related to it. So if you have multiple loans dispersed through the federal program, let's say you have maybe 8 different federal loans at different interest rates, what tends to happen is that all of those loans are sent to the same servicer and they are still, you still make one payment and the servicer will use a weighted average of the interest rates of those loans to charge you the same way that you would be approaching a direct consolidation loan. So because the interest rate can actually go up if you do a direct consolidation loan and the term can be extended, you may not save money consolidating. So I think that's where some of the confusion around consolidation is. You think, oh, I got 8 different loans, I'm going to pay 8 different monthly payments. And that's not typically how it works if you attend the same institution. And so I just wanted to clarify that point because we do get a lot, like you said, Zach, as well. A lot of people think that there's complication when it comes to repayment after you graduate, and it tends not to work out that way. So don't approach consolidation just thinking that is going to be something that's a barrier for you, multiple payments.
Correct. And that was not how it worked historically. We used to have to
Yes.
make separate payments on everything, which is why consolidation and having one payment was convenient. But now the servicers are set up automatically in a more convenient way for us. So consolidation is a little bit less needed in today's federal student loan repayment system.
Absolutely.
Perfect. And then student loan forgiveness and repayment assistance programs. So what is going on here? We have a few different flavors of federal loan forgiveness and assistance programs. So income-based repayment loan cancellation. Realistically, this could also be labeled income-driven repayment loan forgiveness. All of the income-driven repayment plans have forgiveness that are baked into the plan. Under income-based repayment, it depends on which version of the plan you qualify for, but under that plan, you would need to make 20 or 25 years worth of payments before your remaining loans are forgiven. Under the WRAP, that time to forgiveness is 30 years, so a bit longer than the existing options. The big thing to keep in mind here for forgiveness of this type is it is fully federally taxable, which means if we have, if our standard income is $70,000 a year, but then we have $100,000 worth of student loans that are forgiven through this program, in that tax year, our income is no longer 70,000, it is 170,000, and that is going to cause a taxable incidence. So if you are going down that road, you want to work with a tax professional or a CPA to plan for what is often referred to as a tax bomb at the end of that forgiveness process. Then we've got public service loan forgiveness, and public service loan forgiveness is, it's not a repayment plan by itself. It is a forgiveness program that runs in parallel to our loan repayment process. And there are repayment plans that qualify for public service loan forgiveness. And those plans are for the 10-year standard. That is the original standard repayment plan that only those old borrowers or existing borrowers will have access to. And then the income-driven repayment plans all qualify for public service loan forgiveness. Big note here, public service loan forgiveness is not federally taxable. So that loan, that remaining loan balance after we've made our 120 qualifying payments is forgiven, and it is forgiven federally tax-free. So big thing to note there. Teacher loan forgiveness is another federal student loan forgiveness program, and it is for K through 12 educators. There are two different total loan amounts that can be forgiven depending on the type of educator you are and the area in which you are serving. And I believe teacher loan forgiveness is federally tax-free, but I would need to triple check on that. So do not quote me on that. Teacher loan forgiveness exists. I do not know off the top of my head the tax implications for that loan forgiveness type in particular. We've also got loan repayment assistance programs, and there are a few different varieties of these. So some of your schools may provide a loan repayment assistance program that are available to graduates who go into a certain career path, have a certain income coming out of school or something like that. But you may also see loan repayment assistance programs as a benefit offered through future employers as well. So would keep an eye out. If you're thinking about going back to grad or professional school, looking for a school that has a loan repayment assistance program can be very helpful. And then as you are job hunting, looking for that as a job benefit can also be quite helpful. Then National Health Service Corps also has some loan forgiveness and repayment options that are unique to that specific program as well. Although the National Health Service Corps also qualifies as a qualifying employer for public service loan forgiveness. So things to note there. And then real quick on the public service loan forgiveness side of things, that program still exists. You may have seen a lot of stuff in the news around what's going on with the program. The program as a whole still exists, and the only way for the program as a whole to go away is for Congress to pass a bill that gets rid of public service loan forgiveness, and that would require at least enough senators to agree on something that it could get past the filibuster, which just hasn't been something we have seen as a likely outcome here for quite a while. So public service loan forgiveness still exists, still there. Okay. So if you are going into a career in public service or just going into a lower paying career field post higher ed, you do want to be aware of the loan forgiveness options available for you. So knowing what you're eligible for, knowing what your loans are eligible for, going to be very, very important. Understanding how to maximize the forgiveness that's going to be available to us, but also hedging our risks if we don't end up staying in public service, for the whole 10 years to achieve public service loan forgiveness, understanding how to either maximize our forgiveness or hedge our risks through the uses of those various repayment plans. We also want to keep track of all of our payment counts. This is really important because the federal studentaid.gov, those payment counts have, there's kind of no guarantee that they are going to keep accurate counts on studentaid.gov going forward. So now that responsibility is going to be passed on to us as the borrowers to track how many payments we have made under the various repayment or forgiveness programs that are available to us so that we are aware of when we can go ahead and apply for those forgiveness options. And with that keeping track, we want to document all of that stuff. So if we're filling out the public service loan forgiveness form, we want to keep a copy of that for our records. If we email our loan servicer with a question and they respond back, we want to keep that written communication for our records going forward and things like that. So we also want to be aware of when we have to submit paperwork. And the big one here is that PSLF form. If we are pursuing public service loan forgiveness, we want to submit that form at least once a year and anytime we change qualifying employers. So that is something that we want to keep track of throughout the process as well. Now, public service loan forgiveness, we have touched on briefly. The requirements here is 120 qualifying payments. If we make those consecutively, that's going to be a minimum of 10 years. So that is where we hear, okay, 10 years in public service for public service loan forgiveness. It is a minimum of 10 years. Because those payments do not have to be consecutive, it can take us longer then 10 years to achieve public service loan forgiveness, depending on what our career path looks like. The only loans that qualify for the program are federal direct student loans. So you want to make sure all of your loans read federal direct subsidized, federal direct unsubsidized, federal direct grad plus, or federal direct consolidated to make sure that our loans are eligible. You have to be in a qualifying repayment plan. We have noted which plans qualify. And then you have to work for a qualifying employer, which is defined as a level of government, federal, state, local, or tribal, registered nonprofits, so registered 501c3s, and then certain nonprofits that are almost quasi-governmental, like National Health Service Corps and things like that, also qualify for public service loan forgiveness. And also that last little note there at the bottom was that some states do tax public service loan forgiveness. So as you are nearing I would say within the last few years of the process, maybe last 3 to 4 or earlier, you can always double check if your state has a state income tax, how they treat public service loan forgiveness. But that is something that can change over time as states update their tax codes. All right, so is PSLF going to be a valid option for you, and what are the primary considerations here? So it has to be all federal student loans. If you've got private student loans, you can still pursue public service loan forgiveness, but those private loans will not be a part of that process, and you'll have to plan for those separately. Are you going into or do you anticipate you will be going into a field where you're going to be employed by a qualifying public service organization, whether that is a government agency or a nonprofit? We need to make sure that that is going to line up. And then not only are you going to go into that, but do you intend to stay in that spot for at least 10 years? Doesn't have to be with the same employer, but you do have to be in the public service realm for at least a minimum of 10 years to qualify. And then are you intending on using an income-driven repayment plan? Because if we were to use that 10-year standard, we would just pay off our loans before we achieve forgiveness. So we do need to be planning to use one of those income-driven repayment plans. And if all of those things line up, then PSLF may be a good option for you. If there is doubt at any one of those question points, but you are starting out in a public service organization, you can absolutely still fill out those forms and get those payments counting, but you may just need to be prepared to pivot if your career ends up pivoting away from public service and goes into more of the private sector. All right, and I will pass things back to Andrew.
Thank you so much, Zach. We've gone over so much, and I know that we have just a few more slides to get through. I know we've run over the hour. We are recording this if you have to leave, so you will still get this information if you have to hop off. But I do need to go over a few things, like the consequences of defaulting on your student loan. So your loan becomes delinquent the first day after you miss a payment when it's federal loans. Even if you miss just one monthly payment and then start making payments again, your loan account will remain delinquent until you repay that past due amount or make other arrangements such as applying for deferment or forbearance or changing repayment plan. If you go over 9 months without making any payments, it's like 270 days past due or delinquent, your loan is in default. And so the consequences of default can be severe and include things like the entire unpaid balance of your loan and any interest you owe becomes immediately due. This is called acceleration. This also happens with private loans, but it is scary. You also no longer receive deferment or forbearance options, and you lose eligibility for any other benefits, such as the ability to choose a repayment plan. You will lose eligibility for additional federal student aid if you want to go back to school. The default will be reported to the credit bureaus, which will damage your credit rating and affect your ability to buy a car or a house or get a credit card or sometimes even sign a lease. So it's important to keep that in mind and seek options for avoiding the consequences of long-term delinquency that end up in default well before you reach that 9 month without making a payment period. So your tax refunds can also get taken, and any federal benefits may be withheld and applied toward the repayment of your defaulted loan. This is called Treasury offset. Your wages could also be garnished, taken without your consent. And this means that your employer will be required to withhold a portion of your pay and send it to your loan holder or servicer to repay your defaulted loan. And your loan holder could also take you to court for federal loans in the Department of Education, but this can also happen with private loans if you default on a private loan. And in addition to owing all of your loan immediately and any interest due and any late payment fees, you might also be charged court costs, collection fees, attorney's fees, and other costs associated with the collection process. And it can take a long time to reestablish good credit after something like this happens. If it happens with your school may withhold your academic transcript in some cases. They're tending not to do that quite as much. So just keep all of those things in mind because you do have options before it gets to this space. So your options for federal loans include deferment and forbearance. These are tools to use for temporary repayment relief if you run into a situation where you just can't make the payment. Interest often still accrues in these situations. If you're in deferment, subsidized loans won't accrue interest, but some borrowers in income-driven repayment plans have been placed in interest-free administrative forbearance in the past few years. If you're in that situation, I believe that any unsubsidized student loans that are in administrative forbearance right now are now accruing interest again. So you still want to watch any of the loans that you have in deferment or forbearance, even if you're not making payments, see how interest is accruing on that. But you have to work with your loan servicer to see if you qualify for deferment or forbearance if you are having difficulty with maintaining your repayment obligations. So when it comes to deciding how you will repay your student loans, while you're in school, you want to try to keep your debt lower than what your anticipated first year salary is. That's a typical rule of thumb. You also want to build your skills so you can start budgeting now to make transitions easier, and you really want to hone in your budgeting skills or your expense tracking skills so that you can navigate transitions in the future and see where your habits kind of change and shift. You also want to consider cost of living differences if you relocate. So we tend to be primed to think about income from the perspective of how far our wages will go where we live, which differs based on where you live. You also want to keep in mind that public service loan forgiveness is a decade-long commitment. So if you want to pursue that, you want to make sure that that is something you want to stay in for a decade. And don't forget that things can change and you might need income-based repayment or deferment or forbearance to help you navigate all of those things that shift throughout your life, because it's hard to plan for even the next year, let alone the next 10 years. So if your goal is to expedite loan payoff, you want to, again, limit what you spend while you're in school. You might want to consider making biweekly student loan payments, because when you make biweekly payments toward the loan, you take the monthly amount, you split it in half and make payments every 2 weeks. You essentially end up making an extra monthly payment every year. because of doing biweekly payments. You can do that with any type of loan. It doesn't have to be student loan related. You can do it with your mortgage. You can do it with your car loan. It really depends on your individual situation. If you're not paid biweekly, this may not make sense for you. You also might consider signing up for automatic payments using ACH. You'll get a 0.25% interest discount on federal loans if you do that. And if you are paying more than the minimum, you want to apply the additional amount directly to the principal where you can. And then you can either use the debt snowball or waterfall method, whatever keeps you more motivated. The way that people tend to refer to the debt snowball method is prioritizing the lowest interest or lowest balance first. And the waterfall or the avalanche method is you prioritize the highest interest rate first, not the lowest balance. But you can use tools to help you identify which is best for you. And sometimes it's a motivational thing. You also want to pay down principal while any payments are suspended if you're in a situation where you're able to do that, like in deferment or forbearance. All right. Paying more than the minimum can be really valuable to reducing how much you owe. This is just an example, an older example of using the standard repayment plan that's currently available, the 10-year, and just expediting $50 extra than what the minimum payment of $272 would be. And you would save over $1,000 by paying an extra $50 a month towards that loan on a 10-year term and a 3.9% interest rate. All right, again, work with your loan servicer if you need to make payments on your loans, if you want to request changes to your payment plan, if you need to apply for student loan forgiveness. I think that Zach did a really good job of going over all the things that you are responsible for as a borrower. In order to qualify for student loan forgiveness, you need to make sure that you are organized and keep very good records so that you can show them your receipts when you are ready to get a student loan forgiveness process. And then if you do need cancellation, you have to apply for it. Income-based repayment is the only option that has cancellation right now, as far as I know. Zach, do you know what the details are for cancellation under the repayment assistance plan yet? I don't know if those details have been provided.
Yeah, so it is 30 years worth
30.
of payments to cancellation under or discharge under the repayment assistance plan.
Okay. And income-based repayment is
20 or 25, depending on when your oldest student loan was first dispersed. For those where that was pre-July 1, 2014, it's 25 years. For those where that is post-July 1st, 2014, it is 20.
all right. Thank you so much. And again, you can work with your servicer to request deferment or forbearance. And if you need to discharge loans due to permanent disability, that takes a lot of paperwork as well that you'll have to fill out. Loan servicers change, it seems like every 6 months. It's probably not that frequent, but currently these are the student loan servicers that are available through the federal government. Sometimes they switch around and you may also have your loans moved somewhere else. The one thing that we want to keep in mind is to double check on your FSA dashboard if you are notified that your servicer is changing, just to make sure that that is not a fraudulent or scammy activity trying to get your information. Don't forget that you have rights in order to deal with student loan issues. You can also report bad student loan servicers to state's attorneys general. I got corrected about that the last time that we presented this. There's also supposed to be some federal student aid options for reporting bad servicers. And you can also report student loan debt relief scams to the Federal Trade Commission. If you are an Illinois resident, we also have a student loan bill of rights. Not all states have this, but you are entitled to clear and accurate loan information, prompt and accurate handling of payment. Servicers must explain loan options to all borrowers. You also have the right to a payment history information upon request, and you have the right to a timely dispute resolution and appeal if you do run into situations where you need that. You can learn more through the Illinois Department of Financial and Professional Regulation about the Student Loan Bill of Rights and what your options are if you're having an issue with one of your student loan servicers or a fraud situation. So how to file a complaint? You want to identify what the issue is. You want to record all the facts, which you've already been keeping track of, right? You want to collect all your documentation and submit it to the appropriate agency. So federal student aid covers federal loans only. If you have any issues with scams or fraud, then you would report it to the Federal Trade Commission. And you can also call the Illinois Attorneys General if you are an Illinois resident and there are issues that you are having with any of your loan servicers or with scams and fraud. All right, so it's important when you are handling your student loans that you know what you owe, you know who you owe, you have a plan for managing those loans, you know your rights, and you leverage the tools available to you to make a plan, revise that plan, and to institute some type of implementation of the plan. If you are a student at one of the universities in the University of Illinois system, we launched Know What You Owe. We do this campaign every semester and it launched today. So you can participate at the link that we just shared in the chat. We have a little blog post to learn more and participate. If you're not a student in one of our universities, you can still participate. You just won't be eligible for one of the gift card drawings that we have. Some other helpful sites and tools to use include the Department of Education Student Aid website, the Loan Simulator, like we talked about, the Illinois State Attorneys General's student lending page, as well as the Illinois Department of Financial and Professional Regulations page. And then we have a student loan webpage as well that we contribute to regularly, and we also contribute to several blog posts related to student loans on our website as well. If you can let us know kind of how your experience went today, we have a post-webinar survey that you can fill out. Hopefully we can put that in the chat. And then our next webinar is on buying versus renting a home. That will be on Wednesday, May 6th. And you can watch all of our previous webinars on YouTube at go.uillinois.edu/getsavvy. And I want to thank all of my Get Savvy webinar series collaborators. And I know we have at least one question that I think Zach is probably best positioned to answer. So Zach, we had a question in our Q&A that is, how do the changes in available repayment plans for those graduating prior to July 1 affect those who may be seeking public service loan forgiveness? Does consolidating loans reset the number of payments due towards public service loan forgiveness?
Absolutely. So for those graduating prior to July 1st, since you will have no new loans, you will have access to an expanded number of repayment plans that qualify for public service loan forgiveness. In the long run, those will be the 10-year standard, the income-based repayment plan, and the repayment assistance plan. Between now and July 1st of 2028, you can also utilize income contingent repayment, which if the goal is public service loan forgiveness is not going to be the move because that produces the highest payments of any of the income-driven repayment plans, and pay as you earn. For those who are graduating prior to July 1st, pay as you earn may actually be a good plan to start in if you do not qualify for the newer version of IBR. because pay as you earn will produce lower payments than the older version of IBR. So knowing which version of IBR you qualify will be pretty important when you go to choose which plan you're going to start out in. And then consolidation does affect your PSLF counts. It will be based off of the weighted counts of the underlying loans that are being consolidated. So it's not going to completely reset your payment counts, but it will be, the counts will be adjusted. So that is something you would probably want to talk to a subject matter expert about prior to making the decision to consolidate, so we can run through the calculation with you and see how that's going to affect your PSLF counts.
Thank you, Zach. That is much better. I did not realize the weighting factor with consolidation. So I am glad you were here to help answer that question.
Absolutely, and that is a newer change. There was a little while where consolidating actually just completely reset all of your accounts, and you lost access to all accounts payments that you had made prior. So this is definitely the better way for that to work. But yeah, that is newer.
Absolutely.
And
we had a
yeah.
Go ahead.
Yeah, payments made during forbearance, during your grace period, while you are not officially in repayment, will not count towards public service loan forgiveness. You can actually waive the remainder of your grace period. So especially if you're going to be starting a public service job right out of school and you wanted to start making PSLF qualifying payments right away, you can waive the remainder of your grace period and have your loans go into repayment as soon as they're processed under the income-driven repayment plan that you request. So if you're wanting to get a head start, you can do it that way, but your loans do have to officially be in repayment before any payments will count towards PSLF or the income-driven repayment forgivenesses.
I think the other thing that might be valuable for us to emphasize is that with the new transition, any payments made under the tiered standard plan would not count for public service loan forgiveness, correct, Zach?
Correct. So we were hopeful that maybe some of the tiers might qualify, but the Department of Ed has come out and said that no payments made under the new tiered standard will count towards public service loan forgiveness.
So previously the historical standard 10-year repayment plan, if you started making payments under that plan and then decided a year into your career with a nonprofit that you wanted to stay in that work for the next decade, all of the payments that you had made in the prior year would count towards public service loan forgiveness. That is no longer an option. So you can't really delay your decision on whether or not you want to use public service loan forgiveness because of the way that the new standard tiered plan works. I don't know if we emphasized that enough previously, but there was a lot we were going over. I have not seen any other glaringly obvious questions that we didn't specifically address. But Nikki, did you get any private questions, or Emmy, did you see any questions that you think we should go over again?
I did not get any private. I answered a few in the chat, but yeah.
Emmy,
Yeah,
are there any? Go ahead.
Oh, I was just saying Nikki has been handling the questions in the chat fantastically. So I believe all of them have been answered, at least that I've seen.
Okay, excellent. So we will wrap up the recording. Thank you for joining us. If you do have questions later, you can always email studentmoney@uillinois.edu and we will do our best to get you an answer. It may not be advice, but we will give you some context to hopefully help you go in the right direction.